we are unveiling a weapon, a financial instrument engineered not to survive within the fiat system, but to exploit it, hollow it out, and convert its dying breath into Bitcoin. We are talking about the super powerful Strk from Strategy. Strk isn't just innovative, it's parasitic. It pays fiat savers to fund their own obsolescence. It's SEC compliance malware designed to infiltrate traditional finance, hijack its capital, and redirect that flow straight into the hardest monetary asset humanity has ever known: Bitcoin. While Wall Street is still busy repackaging debt and pretending interest rates aren't fake, Strk is performing a quiet coup, restructuring the balance sheet of capitalism itself. Let me be clear, this is the first institutional grade, yield-bearing, Bitcoin-backed perpetual capital vehicle. And it's already rewriting the rules. Let's break it down to its bones. Strk pays an 8% annualized dividend quarterly, based on a $100 liquidation preference. Think of it as a fixed income yield machine, but instead of being backed by government debt or corporate junk, it's underwritten by over 500,000 Bitcoin. Here's the trick: every dollar raised through Strk issuance is instantly used to buy more Bitcoin. This is not theoretical. This is not a narrative. This is coded in the structure: fiat in, Bitcoin out permanently. You are holding a capital instrument that pays you real income in a yield-starved world, converts dying fiat into Bitcoin in real time, and sits senior to equity, but it doesn't behave like debt. Now here is where it gets lethal. Every Strk share comes with a built-in equity kicker, a conversion right into 0.1 MSTR shares, exercisable at any time. Not if MSTR hits 1,000, but when. That strike price isn't a gate, it's a spring-loaded trigger that turns your fixed income into equity rocket fuel once Bitcoin rips through its next order of magnitude. But we're not done. Strk is perpetual. No maturity date, no refinancing cliff, and no repayment pressure. It sits on Strategy's capital stack as a silent sentinel, absorbing capital, stacking Bitcoin, and waiting for conversion to be rational. And Strategy isn't forced to deploy it all at once. They have a 21 billion ATM shelf, giving them surgical control, only issuing Strk when market conditions are favorable. That means maximum Bitcoin per dollar raised, minimal dilution, and perfect capital timing. It's yield with Bitcoin-backed upside, perpetual exposure, and capital seniority wrapped in an SEC-registered, pension-friendly, traditional finance-compliant wrapper. It is quite literally the most elegant, most subversive, and most asymmetric instrument in corporate finance. Strk pays you to fund the very scarcity that makes you rich. Let's dissect the anatomy of the beast. Strk is what happens when you take all the best parts of fixed income, the best parts of equity, inject it with Bitcoin DNA, and remove all the bureaucratic nonsense in between. Here's the breakdown. Liquidation preference, $100 per share. That means you're senior to common equity. In a liquidation scenario, you stand ahead of the MSTR common stock, which, let's not forget, is already backed by 568,000 plus Bitcoin. You're not holding a piece of paper backed by imaginary assets or dying revenue streams. You're holding a claim on the deepest Bitcoin treasury on earth. The coupon, as you can see, 8% annually, cumulative, paid quarterly in cash or MSTR shares. This is a rare species of yield, folks. Bitcoin-backed, fiat paid. In a world where the US Treasury is rolling over $9 trillion in debt this year alone, Strk is saying, here's 8%, no games, no quantitative easing, just coupon sourced from a Bitcoin-rich cash flow engine. And if the market freezes, if volatility spikes, if cash gets tight, the dividend flips into stock settlement mode, preserving Bitcoin on the balance sheet while still honoring your yield. It is built-in anti-fragility. There's a conversion clause, like we mentioned. The holder can convert any time into 0.1 MSTR shares. This is where it gets radioactive. You're holding onto a fixed income instrument, but buried in the contract is a perpetual call option on the most convex equity instrument in the NASDAQ. That 0.1 conversion ratio, MSTR, hits $1,000. Each Strk becomes $100 of common stock, but you bought it at a discount and got paid 8% the entire time. And there's no waiting period. You can convert whenever you want, folks, but the moment that $1,000 trigger is hit, the economic logic screams convert now. Not financial advice, of course. This is financial entertainment. Then there's a redemption clause, which is callable only after 75% of original issuance is retired, which means Strategy can't rug you tomorrow. They must wait until the float is mostly cleaned up. And if they do redeem, it'll likely be financed by cheaper capital or cheaper Bitcoin, net accretive to shareholders. And there's also voting rights if 4 dividends are missed. So this isn't activist investor catnip. There's no boardroom drama. There's no proxy fights. You don't govern anything. You just get paid. This is pure economic exposure. No governance baggage, no activist headaches, just clean upside and predictable income. In total, Strike is not a bond. It's not equity either. It's a hybrid missile engineered to absorb fiat, convert it into Bitcoin, and reward holders with cash flow until it detonates into equity. We're going to talk about how Strike weaponizes Bitcoin on Wall Street. This is where it gets diabolical, folks. Strike is not just a smart product, it's a system exploit. Let me walk you through the recursive Bitcoin flywheel, the most potent capital feedback loop ever introduced to public markets. Step 1, you issue Strike to tradfi allocators, so think pensions, endowments, insurance companies, yield-starved institutions legally barred from ever touching Bitcoin. Step 2, you're going to use the proceeds to buy Bitcoin. The fiat flows in, Bitcoin is acquired, Bitcoin per share rises, and the treasury grows harder. Step 3, the Bitcoin price is going to appreciate because we love our digital scarcity, folks, and then the MSTR equity premium will then rise. Bitcoin is the base layer, MSTR is the amplifier. As Bitcoin climbs, MSTR becomes a leveraged Bitcoin proxy and its equity rips higher. Step 4, Strike conversion becomes economically rational at $1,000 MSTR. Fixed income holders start converting into common stock, more equity is issued, but that equity fuels more Bitcoin acquisition. And then step 5 is repeat. Each cycle reduces the Bitcoin float. Each turn compounds the scarcity of Bitcoin. TradFi thinks this is clipping coupons, but in reality, it's amplifying the Bitcoin supply shock in real time. The thing that you really need to realize is that Strike weaponizes capital markets into a Bitcoin vacuum engine. And the best part is that this is all SEC compliant, GAAP legitimate, TradFi approved. Strike is the clean interface between the collapsing fiat world and the rising Bitcoin standard. Think of it as a Trojan horse that waltzes into the gates of every pension fund on earth, one preferred share at a time. It offers them what they crave: income, seniority, structure, but in exchange, they become complicit in the inevitability of Bitcoin monetization. And once they hold Strike, they're already orange-pilled, whether they know it or not. Now, we kind of touched on this a little bit, but this is where it gets surgical. Institutions, the pension funds, insurance companies, endowments, what I just said, they all want the Bitcoin exposure. So a really quick recap, because I believe that Strike solves for every traditional finance constraint. Pays yield, 8% annualized, predictable, fiat denominated. It's SEC registered, regulatory green light. It's GAAP equity treated, which means it fits nicely in traditional capital models. It's equity and not crypto, so there's no need for new custody infrastructure. And it offers optionality, but only if the asset moons, which I know that anybody watching this, we all probably think it will. To the chief investment officer of a pension fund, Strike looks like a beautifully boring preferred share, but what it actually is the Bitcoin-wrapped, yield-bearing, boardroom palatable gateway drug into hyper-Bitcoinization. These kids think they're buying Bitcoin yields, but we know they're underwriting the Bitcoin standard. Now let's flip the lens. We've talked about how Strike infiltrates TradFi allocators, but what about corporations? Let's be clear, cash on corporate balance sheets is melting. Real inflation is 10% when you strip out the statistical fiction that we're bombarded with from the government. Treasury yields are nominally positive, but after tax, after inflation, they're still yielding less than zero, let's be real. So what does a CFO even do? They need cash reserves, but holding fiat is suicidal over a 10-year horizon. Debt's getting expensive. Equity is dilutive, and buybacks don't protect cash from entropy. Strike is the template for the post-fiat treasury strategy. Issue Strike to the market, take the proceeds to buy Bitcoin, you know, the hard money with global liquidity, optimize your capital stack, have Strike sit below your debt but above the common stock, no risk of a default, no voting, no drama. You preserve your balance sheet agility this way. Dividends can be deferred or paid in MSTR stock. It's not debt, it's not common equity, it's a new category. Bitcoin collateralized, yield-bearing, perpetual treasury capital. Michael Saylor had this idea where he's going to demonetize corporate cash and replace it with an appreciating, self-marking monetary asset, and that's the playbook. And you better believe other CFOs are watching. In the 2008 crisis, companies scrambled for liquidity. In the 2020 crisis, they scrambled for yield. In the next crisis, they're going to scramble for hard money. And the first corporations to issue Strike-style preferreds will front-run the collapse of the fiat curve. So stop thinking of this as a funding mechanism. It is Bitcoinizing the corporate capital stack, quietly, permanently, and profitably. Let's get clinical. You're managing capital. You have 4 options in front of you: Strike, Strife, 2031 convertible notes, and straight MSTR common. Which one do you pick? Let's run the matrix. Let's talk about yield. Strike gives you the 8% cash yield, but Strife gives you 10, but they have 0 upside. The convert's 0.625%, basically a participation trophy. And then the common stock is 0. You're just praying for number go up, which is fine. You know, we all do that a little bit. Strike strikes the balance, pun intended, high yield, but with optional upside exposure. Remember, Bitcoin upside. Strike converts into 0.10 MSTR, meaning if Bitcoin moons, you go from fixed income to missile fuel. Strife has the locked yield, so there's no torque. Converts, yes, but with a low coupon and a long fuse to them. MSTR, sure. Pure exposure, but with 0 buffer. You ride naked. Strike is giving you the convexity with a cushion. The downside buffer, Strike has a $100 liquidation preference plus the cumulative dividends. You're literally paid to wait. Strife has the same preference, but no equity option, and the converts are senior unsecured. They're lower in the stack. And MSTR common, you eat the volatility raw. If this is a bear market, Strike is a shelter with optional moon tickets. Let's talk about duration risks between all of them too. Strike is perpetual, so there's no forced refinancing, no ticking time bomb, callable only after 75% is retired. Strife, same exact thing. The converts mature in 2031 and they carry the rollover. MSTR, infinite duration. The market can punish you with no floor. Perpetual does not mean risky. It means you can sit and wait until the bull cycle comes to you. So as you can see, guys, Strike is really in the Goldilocks zone. Real yield, senior stance. Optionality built in with Bitcoin DNA under the hood. If you want to stack Bitcoin risk at a structural discount while being paid to do it, Strike is your play. Now let's be adults. There are risks. Nothing is immune to the thermodynamics of capital. But Strike doesn't manage risk necessarily. It metabolizes it. So if you ask, what if Bitcoin price crashes and strategy can't make the dividend payments? The answer to that is that the coupons are cumulative and can be paid in MSTR shares. The Bitcoin stays on the balance sheet and you get the equity upside during the reset. This is not default. This is just delayed gratification with the upside torque. You know, the risk of conversion dilution. What if everybody converts and floods the common stock? But that only happens if MSTR screams past $1,000 driven by a Bitcoin moon. Yes, you dilute the float by about 6%, but only after massive NAV expansion. You're being diluted into a bigger pie. That's not dilution, that's monetary reproduction. And the risk of a regulatory clampdown. Could regulators attack this structure? It is SEC registered, with full disclosures and conservative treatment of Bitcoin as a treasury reserve, which is not a speculative trading position. If they attack Strike, that means that they're attacking compliant capital markets for owning an asset that's now held by BlackRock and Fidelity. So if that were to happen, I don't think that's regulation. That's more like regime collapse. And then there's one more, interest rate shifting. What if rates explode to 10+% and Strike trades below par? Strike is perpetual, and if you're a long-term holder, you care about total return, not mark-to-market volatility. And in that world, Bitcoin likely becomes stronger, not weaker, because fiat has officially failed. The embedded conversion optionality acts as a hedge against the monetary dislocation. In total, Strike is not fragile because it's engineered to thrive on chaos. When the world breaks, fiat yields collapse or spike unpredictably, Strike just sits there accumulating Bitcoin, stacking value, and compounding scarcity. It's really nice to be exposed to the hyper-Bitcoinized upside. Now, this is my take here, folks. This is the part of the story that nobody's supposed to hear. I mentioned it a little earlier, but this is more detail. Strike is not just the yield. It's not just the structure. It's not even just the Bitcoin. It is a moral weapon in the capital markets war for monetary sovereignty. And this is the red pill reality, folks. Strike pays the fiat savers to fund a Bitcoin supply shock. The very people that are most resistant to Bitcoin, boomers, pension funds, insurers, conservative allocators, are now literally earning dollars for reducing Bitcoin's available supply. They're all unwittingly executing the trade that destroys fiat dominance. It's converting the legacy capital into hard money collateral. Every single one of these people buying Strike, they're going to be onboarding themselves into a Bitcoin-dependent future, because as Bitcoin appreciates, the Strike equity exposure increases exponentially. It's a legal gateway drug. Strike is SEC-approved financial crack. Once institutions hold it, they're already Bitcoin exposed, compliantly, quietly, irreversibly. They don't need custody. They don't need to update mandates. They don't even need to know that they're doing it. They're orange pilled by yield. The conversion terms of Strike are like a macro bet on Bitcoin going over $500,000. You don't buy Strike unless you believe Bitcoin will structurally reprice global capital. Buying Strike is a levered yes vote on hyper-Bitcoinization wrapped in a dividend stream. And we're just going to continue to see this happen. The fixed income market is going to be totally eaten by Bitcoin. The market will begin to price fixed income risk through a Bitcoin lens. And that's how the fiat debt curve is going to die with the slow reallocation of capital to harder instruments. Strike is the seed crystal of the Bitcoin capital market superstructure. Let's zoom out, folks. Let's look at the war chest that we're dealing with. There is approximately $160 trillion in ultra-liquid fiat capital sloshing around the global system, 140.7 trillion in global bonds and notes, 12.36 trillion in central bank reserves, 6.9 trillion in money market funds, all of it sitting in fiat instruments, bleeding, debasing, melting. So what happened if just 1% of that flows into Strike style hybrids? That's $1.6 trillion of capital diverted from fiat debt into Bitcoin backed preferreds. At 105,000 per Bitcoin, I think that's the current price. I might be wrong, but that capital buys 15.2 million Bitcoin, roughly 78% of the entire circulating supply. This is not a fantasy, folks. So don't get too hyped, but this is reality. This is a first mover arbitrage waiting to be claimed. Every Strike issuance tightens Bitcoin's free float. Every coupon paid makes the product more attractive, and every pension fund that allocates to Strike is just funneling fiat into the Bitcoin vortex. You are witnessing with Strike the monetary re-architecture of the global bonds market. When sovereign bonds become untrustworthy, when cash becomes debt, when duration becomes risk, capital will seek yield, capital will seek Bitcoin. And Strike is the first real gateway. This is the conduit from which the fiat capital order is drained, restructured, and repriced into the Bitcoin native regime. Let's be empirical. Let's show the math. I can do that. You think I'm just hyping you up without the math? No, let's back this up. You buy Strike at $80 per share. It's trading higher than that, but for example, that's what it was initially listed for. You get an 8% annual coupon, which is $8 per year on a $100 par, or $24 over 3 years. Now let's see what happens based on where Bitcoin goes and by extension where MSTR goes. We'll assume a 5x beta of MSTR to Bitcoin. Historically, that's not unreasonable. It might even be conservative. At the low end, if Bitcoin hits 150K, you're already outperforming most corporate credit with a bond-like floor and par protection. But once MSTR crosses $1,000, Strike stops being a yield product and starts behaving like a long-dated call option on monetary collapse. At 300 Bitcoin, you more than double your capital. At 500K, you straight up 3x. And at $1 million Bitcoin, let's pray, your Strike position would return 6.5x in just 3 years, with a paying coupon the entire way. This is how you yield farm on Wall Street's balance sheet. Your downside is cushioned with the preference and the coupon. Your upside is exponential, clearly, as you can see, and triggered by the very event Bitcoiners believe to be inevitable. And you don't need leverage to pull this off. The structure does it for you. You are being paid to hold an out-of-the-money call on the monetization of Bitcoin while you are farming fiat while financing hyper-Bitcoinization. Wrap your head around that. Okay. Another step back. We're getting heated here. What is Strike really? It is a piece of financial engineering so elegant, it hides its revolutionary nature inside a compliant wrapper. Let's call it a Bitcoin mining rig for capital allocators. But instead of burning electricity, it's burning fiat. It allows you to stack an 8% coupon while everyone else chases yield into rotting treasury bills. It sits senior to the common stock with real downside protection. You keep perpetual exposure with no maturity cliffs. And you access asymmetric Bitcoin upside without having to custody crypto. And then you strip mine traditional finance capital flows and redirect them into real hard money. Strike is the first instrument that makes Wall Street complicit in the monetization of Bitcoin. This is a vector. It's a financial weapon forged in the fires of a collapsing fiat order. Every dollar raised tightens the Bitcoin float. Every quarter you're paid, you're helping defund fiat's future. Stay humble, kids. Stack the yield, fund the future, let the coupon buy the dips, let the float collapse, let the old world fade. Because with Strife, we're not just front-running hyper-Bitcoinization, we're engineering it.